I don't drink a lot of bourbon at home. I'm like more of an Irish whiskey Scotch guy, but I have a cat whose name is Bourbon. If you can believe it.
Cat in.
Yeah.
Welcome to Bourbon with One Urban. I am your host, Nick Stilo, and my co-host, Joe Villar.
Welcome back, everyone.
But, we can't really call it Bourbon with One Urban right now because the LCBO doesn't have any American product.
Yeah, I was at the LCBO yesterday. I'm looking, where's the bourbon? I don't see any bourbon on the shelves.
Maybe we should redo this introduction. Welcome to Canadian Whiskey with One Urban. I'm your host. Now, it's still Bourbon with One Urban. We're just going to pretend like this is bourbon, but it's not. It's actually 40 Creek Barrel Select Niagara Whiskey, and LCBO describes it as 40 Creek is often credited for the renewed interest in quality Canadian whiskey. The original pours a medium amber and offers complex aromas and flavors of apricots, caramel, spice, vanilla, ginger, and toasted oak, ending in a long, smooth finish. Our first guest today is Ian Wilson, Vice President of Origination at Cameron Stevens Mortgage Capital.
Yep.
So Ian sources and structures new loan opportunities, manages client relationships, and mentors future originators and analysts. In 2024, he originated $400 million across 20 transactions, earning top originator status. His financial background and expertise in credit and sales drives best practices in commercial real estate, debt structuring. Ian also champions community engagement, reinforcing the company's philanthropic commitment. Ian holds a bachelor's degree, an honors Bachelor of Commerce in the University of Guelph's School of Management and Economics. Cameron Stevens is a leading Canadian commercial real estate investment manager, oversees $4 billion in assets, partnering with developers to deliver strong risk-adjusted returns.
Wow.
Welcome, Ian.
That was quite the intro. Thanks, guys. I
Welcome,
appreciate
Ian,
that.
and cheers. Oh, Canada.
Cheers.
Yeah.
Oh, Canada. You know what? I like the little pivot that we've done to rye today because my father-in-law is a big fan of 40 Creek, so it's fitting with what's going on in the world right now.
That's very nice. It does have a long finish.
delish.
Vanilla.
I do like that.
Honey
There's
tones I sense on that one.
I do like that. So $400 million last year. That's across 20 deals. That's an average of $20 million a deal.
Yeah, that's right. I mean, and our space, our Cameron Stevens in particular, the market has been pretty frothy with the insured product, the CMHC, as you guys both know.
Mm-hmm.
Also, let me just take a step back and thank you for having me on the show.
Thank you for coming.
Groundbreakers. I see what you guys are doing. In particular, I've been to Oakville, I've been to Barrie. You're building the homes that we need, and I saw the most recent deal on 440 ESSA. So congratulations.
Yeah, thank you.
Thank you.
That would be a CMHC deal, which is kind of the segue a little bit here. Cameron Stevens is in the middle of becoming an approved lender. We're very close. But all those deals were conventional. So the market has tightened, and doing conventional land development, construction lending, a pivot to income producing, it's a challenge, and it continues to be, but we're pressing forward, and hopefully there's some light at the end of the tunnel here, and I'm sure we'll talk about that today.
Are you finding a lot of developers that are now pivoting to purpose-built rentals that were traditional condo developers, and now with CMHC's incentives, either through ACLP or apartment construction loan program, or MLI Select, which is their insured program? You finding a lot of developers shifting in that direction, and either doing a forward sale of their asset or actually keeping the asset, like One Urban?
It's a great question. There's probably 10 different answers. To try and summarize, yes. If you have like a high density intended for sale condo development site and there's no sales, like you look around the last 2 years, there's no revenue, right? So what do? Do you have a medium to high leverage mortgage on it? Can you afford to keep going for, let's say, 2 years, the market comes back? I don't know if that's going to be 2 years or 5 years. But if you are feeling the pressure from a cash flow standpoint, rental is the next obvious choice. You remove the biggest condition precedent on funding a loan, which is pre-sales, right?
Pre-sales.
So I'm seeing lots of people pivot. I don't think it's as easy as just flicking the switch.
No, it's not. We went through that.
The building has to be redesigned
6 years ago. That's right.
Yeah.
Probably much more amenity driven. I mean, you guys can speak to that, but There's groups out there now that sort of help facilitate that process who are reaching out to me like, hey, you have condo developer sites. Let me sort of get in front of them if they want to pivot to rental. I can help with that. But yes, but the cash requirements on rental are often higher than condo. Let's say you do a condo construction loan, I would ask you for 10% equity. The deposits and the deferred costs will take you up to, let's say, 20% of the capital
25,
stack,
yeah.
and I'll do 75 to 80%. I'll do the balance, right? So with respect to CMHC, it's been great. Like I was at RealCap recently. I think she was the president and COO was there speaking, and she basically raised her hand and said, "Listen, this is like a social program that we have. We're trying to build as many homes as we can, but we need help from the conventional lenders to sort of fill this space. We're sort of oversubscribed, let's say, for lack of a better word." So, and as a result of that, they've pulled back. So the rental holdback program, where you're only achieving your high leverage CMHC loan once you've proven out the rent in the market. That's a real impact. There's COIs out there that are stuck at, let's say, 70-75% leverage. And these groups are asking us to do a second mortgage
yeah.
up to whatever, 80,
85.
85. Yeah. So what I'm saying, and I'm saying this to anyone who's building purpose-built rentals right now, is let me do the Cameron Stevens traditional AB. So what is that for the listeners? Cameron Stevens manages just shy of $4 billion in assets. I would say 700 million of that is our proprietary capital. That's like 10% money, back end money, mezz money. And then we have inter-lender syndication agreements with basically every life co, credit union, bank across the country except the big four. Okay. So we'll put them in a deal. It's all one mortgage. They'll be at their conventional leverage, let's say 50, 60%, prime plus one. And then if the borrower is looking to bridge to some milestone, put in less cash or less pre-sales or something that requires leverage or even just a return on equity, we'll take that leverage up to whatever it may be, 75, 80, purpose-built rental construction, maybe 85. And you'll see like a blended rate. You won't see a first mortgage at prime one and a second mortgage at 10%. You'll see like a prime plus two type of deal. So I'm now telling people about this product of ours, conventionally constructing apartment buildings, where like some recent examples, I'm not going to like name developer names or locations or anything, but like we're getting 85% loan to cost, now true cost, not land lift, done, and shy of prime two, for like a 3-year deal. So you build the apartment, let's say that takes 24 months and you have a year to lease it up, and then it's CMHE is the obvious exit strategy, but we've been tasked with underwriting to conventional term lending, so like 30-year amortizations and higher pricings, just to prove that our BPs can be taken out. And if not, if there's a stub, that's okay. But we are really focusing our underwriting on strong borrowers, strong liquidity. So if at the end they need to write a check for $1 million or $2 million, it's not a stressful situation.
So,
CMH
yeah, go ahead.
I was going to say CMHC is not an easy nut to crack. I mean, we've been through it now twice. The first time was equally as hard as the second time. I can't say that one was harder than the other. We felt that the deals took a really long time to underwrite, get an actual underwriter on, the file, and they kept coming back multiple times for all kinds of stuff. It was almost an onerous task to actually get this approved. But once you're approved, the loans are high loan to cost, and they will actually do high loan to cost with land lift. And a moment ago you said true cost, so without land lift. So basically you're not in your AB model going to recognize the land lift that's achieved through the land entitlements process.
It's a great question. I'm on the origination side of the business. It's my job to have relationships with you gentlemen and bring deals forward and structure deals and get them signed up in the market. And I've tried to have land lift included. The feedback is 50-50. It's split on even though our own investment committee and some of the partners that we deal with wanting to include it and not wanting to include it. So just as the baseline for talking about today, I'm saying no. And I think that's probably...
That makes a huge difference.
Yeah. Oh, I know. Well, imagine you bought a site in 2000, right? Yeah. It's all land lift. You probably have no cash in the deal.
That's right.
Right.
Yeah,
So
you bought a site for $1 million back then. It's now worth 20.
Yeah.
That 19 million, in our opinion, should be recognized.
listen, I don't disagree. Like it's all case by case. I mean, if you bought a site in 2021, probably not. If you bought a site in 2012, maybe. Yeah. It's hard. It's all case by case.
Yeah.
Yeah.
So we've been seeing a steady decline in interest rates over the past little while. Are you seeing any impact at all on your side of things?
I like that question. So when interest rates were going up, I would say it was like 12 to 18, maybe even 24 months. You start to see the impact of what's happening. It's a lag, right? So I think it's a lag now as well. Um, I would say talking to developer clients of mine, particularly in the low rise space, who are entitled and potentially ready to either soft launch or fully launch a sale. Um, at the end of 24, they were all like, you know what, interest rates are going down. I'll launch in March or April. And now in between that, we've had a provincial election. Seems like we're right about to have a federal election.
Anytime now.
And we've had President Trump come in. So that's been a huge curveball. And now they're not really, now they're like, oof, my April 1 launch might now be an October 1. And it's,
Which on its own is risky too. Waiting until October, you're right before Thanksgiving, you're almost at Christmas. The investors really aren't thinking about investing in condos. Could be a risky move for them.
So I've flat out asked basically that same question that you just asked me. What's more important in order for you to generate sales revenue? Is it interest rates continue to decline, but you have economic turmoil? Or if the turmoil goes away and the rates, let's say, hold, and it's a unanimous get rid of the economic turmoil because purchasers are worried they won't have jobs and can't afford a home. So I guess that's how I would answer that.
So you're saying a lot of outside factors other than interest rates are impacting
Yeah,
the economy right now.
exactly. And let's hope that whether it's the Liberals or the Conservatives in Canada, once the election's sorted, you'll start to see us. I don't know, get our act together or get more organized. Like maybe what President Trump is doing right now in terms of just disrupting all our pre-negotiated agreement. Maybe it's the kick in the derriere that we needed to look ourselves in the mirror and become more self-reliant, get rid of all these interprovincial trades. This impacts the tariffs and everything. So, you know what? Maybe you got to look at the glass half full.
So do you think, you just mentioned tariffs, do you think tariffs will have an impact, this potential tariff increase will have an impact in the housing?
Again,
market?
I'm asking my clients what they think. I've heard 2 to 4% from builders. I was at the Real Cap conference recently, and forget who it was on stage, but they mentioned the number 4% as well, with the caveat that you should, within your pro forma, be able to overcome 4% and still have a viable project. But then when I talk to the cost consultants that we work with at Cameron Stevens often, their numbers are more like 7 to 12%. So that's a much bigger gap, and
It's huge.
Yeah,
it just at the end of the day, developers have to make a profit to make homes, right? The margins are shrinking. The costs get passed on to the purchasers or the renters, right? So it just means less housing starts like almost going backwards. We need federal help, provincial help. We just need something more positivity in the newspaper.
It's all doom and gloom. Everything you hear.
Yeah.
When you turn on the radio, you turn on the news, you turn on your phone and you look at your news. Everything is doom and gloom. Totally. There's nobody right now that has a good news story. Tariffs are hurting everybody, or at least the threat of tariffs are hurting everybody. And we ask around to our developer peers and to banks and to cost consultants, and honestly, everybody's scratching their head. Nobody really knows how to handle it.
I know. Like anyone I'm talking to is waiting, who can afford to wait, let's caveat that, to make a big capital decision once the federal election is behind us. I don't know if this tariff noise will go away. I sort of think about Trump like he's almost on house money, right? He's got this second term. Like he beat a case and he's back in office. He didn't even beat the case, he lost. But anyway, somehow he got elected again. And he's got 2 years before the midterms where everything might reset and his mandate might get a lot smaller. So he's swinging for the fences right now in everything he does. And hopefully within 2 years, that balance will come sort of more back to center and it'll be a little bit more normal. But in the meantime, we're going to be negotiating deals, and we need a federal leader in there who has that ability to put our best interests first.
I mean, if we're going to talk about federal leaders, though,
is this a politics podcast? I digress.
It's not, but we're talking about tariffs and the threat of tariffs. Where was Justin Trudeau? Where was Parliament? in all of this. I understand that they were waiting for the election of a new Liberal leader. But this is a crisis. This is an emergency. Where was Parliament? Where was Poilievre? Where was even Carney just made his first trip as Prime Minister and he went to France.
I just want to see a strong mandate from a new PM. I won't show my political cards, but I just want there to be some more organization internally.
If there is a new PM and it is Pierre Poilievre, the ACLP program and MLI Select program may disappear,
Right.
which will then further decimate the redevelopment or the development of purpose-built rental buildings. Because right now, a lot of developers, including One Urban, were hanging our hats on CMHC and using them as our lender and our insurer of our loans. We couldn't do these kinds of deals with the equity requirement of some of the buildings that we're building. Do you think that Poilievre would actually come in and repeal all of the Liberal government's housing mandates? I mean, because it's really not in his, election campaign, right? There's no promises about housing. He says we're going to build more, but he's also been very vocal about CMHC and the amount of staff that's at CMHC and the redundancy in some of the roles there. Do you think it's possible that he might repeal the program altogether?
I don't know about that. I mean, we've seen some positive momentum. We in the HST self-assessment and Mississauga recently with their announcement on DC reductions and deferrals for purpose-built.
That's at a municipal level.
I know, but I don't. To answer your question bluntly, I don't know. But our underwriting criteria is shifting on an assumption that CMHC won't be there anymore, just to absolutely protect our downside. And I guess I'll just leave it at that. Like, we're underwriting, you have to get a conventional term loan from a bank at a much lower amortization than CMHC in order to, we're so focused on exit strategy. Like, you get into a loan, but how do you exit? And is it a viable option? Are there multiple options? And we're looking at the absolute downside that, CMHC might not exist when these buildings come to fruition. So
yeah, we're talking to some of our underwriters at CMHC, and they're all saying the same thing. I might not have a job next year.
Right.
So
Scary stuff.
that is scary stuff.
Yeah. Yeah.
What a time. What a time. The economic uncertainty rather is actually having an impact even on rentals. I mean, we're seeing that rentals are down year over year, which I don't understand, because if you can't afford to buy, where are you living if you're not renting? So why aren't a lot of the inventory that's available renting? And maybe it's a case where there's just too much inventory. A lot of the projects that we're finishing up over the last few years have now come online, and we have all these units available, and that's causing demand to go down because supply is up. I just don't know why. I mean, we look at our purpose-built rental, and it's steadily leasing, slower than we thought.
Yeah.
But it is leasing. And we've got an affordability component there, which also helps with the lease up. But, I just can't put a finger on why the rental market is down.
Affordability. What's the definition of affordability in these buildings? You could have a whole podcast on what the definition of affordability
Yeah, we can.
is.
Affordability is why you're probably better.
Right? Affordability is basically how much you can afford to you run your day-to-day affairs.
Well, I think his
trust,
question
right?
is what's the definition of affordability, and if I'm right, through CMHC, right? And what an affordable unit is.
I'm just
CMHC's
thinking
terms.
more holistically. Like, is it who are you targeting with those programs? People probably with two good jobs.
Yeah.
It's not necessarily what you might think of, like, poverty is the wrong word, but like lower income. I don't think it's that. And I know, or you can help me describe this. If you have to put an affordable component in your building, is it a break even? Is it a loss leader? Does it award you more density? Does it award you DC? Like, you need all of those things to still want to go forward with the project and actually deliver more units for the community. It's like a real catch-22.
Yeah, definitely.
I mean, holistically, it's a great idea. Socially, it's a great idea. We need to have all walks of life be able to live in the city or in the 905 or what have you. But as a developer whose covenant is on the line, whose reputation is on the line, whose money is on the line, if you have investors whose investors might, it's a lot. It's a lot to ask.
one of our lawyers, Edward Lind rather, at Fasken, says the construction and development is the epitome of risk.
Yeah.
And I couldn't have said it better myself. People out there that look at developers, and I think the days of making money hand over fist when condos were being sold, and even low-rise houses. In fact, we were just talking to another one of our lawyers recently, and some of the low-rise guys that bought land 30, 40 years ago, there's zero land cost in it. And when they're selling these $2.5 million homes, their return on that home is almost $1 million on that one home. So you got a developer that now sells 100 of them. There's $100 million in profit on that one project. That's a lot of money. But those days are really gone for the most part and for the majority of the developers around. So it's not easy to turn these projects over. Projects are very difficult to get into the ground. They're very difficult to get out of the ground, and they're even more difficult to finish.
Yeah.
And the profits just aren't there anymore. And like you said earlier, right, we need to make money in this business. But all that being said, where do we go? What's the future outlook here?
So just to finish your thought there on we need to make money and having land banked for ages is, the best way to make money is you buy your land well. It's not really a secret, because if the market goes up and down, the land value fluctuates, right? So the big land bankers are going Southwestern Ontario, Paris, Ontario, right? Brantford, they're buying up huge swaths there.
Secondary and tertiary market
to bank for the future, right? Yeah. So in terms of the fundamentals of where do we go from here, I still think the fundamentals are very strong. I've heard one of my colleagues describe the greater GTA, all the way down to Niagara. Is probably the best place to build in North America right now. Notwithstanding, we've had it really good for a number of years. It was probably too frothy. It was easy to make money. It was easy to come into the industry. And there needed to be a correction. You would read about a bubble in the paper every weekend, right? And it was almost like a joke, but then the bubble burst and it got exacerbated by everything else that's going on right now. That's right. There's going to be some, I want to say short term. I hope that's 2 years, hopefully 26 we're, in the best case scenario. But I do think long term, I don't think you invest in real estate on the short term.
No, you never.
Anyway,
real estate is always a long-term play.
You want to have a vision towards the fundamentals 5, 10, 25 years from now. And I think there's no better place to build still than let's say Southern Ontario.
We hear a lot lately of developers, legacy developers that have projects that are bankrupt and going insolvent, and even some names that, out of respect, we won't mention anybody's names, but some big names out there. That's really scary when you have some big legacy builders that have been in the game for 40, 50 years, and now they're going insolvent on either a project or on a portion of their portfolio, or even the majority of their portfolio. That is some really scary stuff, man.
Definitely. Yes, it's scary. And let's park the the generational builders, really big builders, for a second. A guy like myself, I see all sorts of deals on the street, and a lot of it is, hey, can you do this land loan, give me a new interest reserve, and buy myself 24 months for the market to correct? Or can you restructure this loan that you have on the books? And it's just a lot of hanging on to hope for better times. You need to, when you're looking at a new project or your project today as it stands, you need to underwrite today's revenue and today's costing. Anything else is irresponsible. You can't just assume, even with the inflation, let's say 3%, you need to look in the mirror and underwrite today's revenue and costing. And does your project work? And the answer is likely no. And to make it work, let's say you're underwriting a condos topical. You need to sell condos for $1,000 a foot to actually have sales. And then you make no money. Yeah. So if you're working your way backwards to a land residual, did you buy your land at downtown at $250 a foot? That land today might be worth $50 a foot. So is
that a true number?
Yeah. Yeah. Like, listen, like a lot of people will hear this. Clients of mine, appraisers will say, Ian, like you're being a little too bleak here, but we have sites, Cameron Stevens, with a cost base of 60, 65, $75 a square foot. And we know we have to hold on for a couple of years. And we're also looking into potentially a pivot to rental. So like anything is on the table right now in land, the bid ask spread is still so large that it's hard to agree on a loan to value or a value that makes sense. And so conservative is better. I want to be doing, I want to have a strong book and be doing podcasts instead of a book that's in receivership and I'm working out files. So
I think that what we're going through right now is going to shake out a lot of the, tire kicker developers, the guys, and nothing against these people that, everybody wants to make a buck, right? And they see an opportunity, and I've seen it over and over. You either get a small group of investors that have no business being in the real estate development world, or they're realtors. I've seen a lot of realtors do this. They'll buy a piece of land, they'll get a few of their family members together, they'll hire an architect, put it through land entitlements, you get their uplift on their land, and they sell it. They flip it, make a couple of $1,000,000 or whatever the case may be in a short term. And I think that we're going to see an exodus of those.
definitely. And I
Because
think
they can't, sorry to cut you off there,
No,
but
it's okay.
they just cannot play that game anymore. It doesn't work.
no.
And at the same time, on the trade pool side, I think that's going to happen also on the trade pool side, where the big guys, the drywallers that have 500 guys on their payroll, the form workers that have 500 guys on their payroll, those guys, they've got the bandwidth behind them to be able to sustain these hard times.
Right.
And you're going to get an exodus of all of these smaller drywallers. And I'm just nothing against drywallers. Please don't, if you're a drywall company out there, I have a lot of respect for trades, and I've been very vocal about my respect for the trades that are the backbone of our society. But you're going to get a lot of these smaller companies that, just a few guys or a couple of crews, they're going to get wiped out. Yeah. There's absolutely no way they can sustain,
Or absorbed by some of the bigger guys.
or be absorbed by them.
Yeah.
Yeah.
Yeah, it's interesting how this will all shake out. I don't know. We're in it right now for sure.
I mean, I think we've addressed the fact that I think there's a number of different factors at play here. Interest rates is one of them. I think also municipalities have a role to play in this. I think there's some streamlining that could be done in terms of approvals, and a lot of red tape that could be removed.
Remove development charges altogether. Cash in lieu of parkland.
Exactly.
I mean, what's the kitty that the kitty fund, if I can call it that the city of Toronto is sitting on right now? It's like $8 billion,
Which is just DCs that have not been
which
put
is
to use.
DCs which have not been put to use.
Yeah.
Right.
Like, come on. But yet they continue to rise year over year. And okay, right now we're going to see a slashing of DCs in Toronto, and Mayor Chow announced that, and other municipalities are following suit. Mississauga, like you shared earlier,
Vaughan has done
that
major
already.
step. Yep.
They've cut 50% of their DCs, and other municipalities that we're looking at are in some instances, depending on where you are, if you're in the downtown core, they're eliminating them altogether,
Right.
and following suit to the federal government, and what they're doing with purpose-built rentals, and affordable housing. But it's not enough.
Right.
It really isn't.
Well, the bottom line is the consumer pays the price. So
That's
if,
right.
if you want, like, what would you rather have if you're a municipality or any level of government? Would you have a tax base? Okay, help us out, or no tax base if you don't
That's
help
right.
us. Like, it's just,
That's right.
I mean,
That's right.
It
It's either
seems like
one or the other.
it's not as simple as I suggest, but it's not that far off, right? So
Some interesting times, man.
Yeah,
We're in some interesting times. What's really interesting is this 40 Creek Barrel Select Niagara whiskey. That it's actually my first time trying this particular 40 Creek. I found this to be a lot smoother than I was expecting. Definitely smoother than some of the bourbons that we've brought in here. And I actually really, really like this.
would you
And
ever drink?
locally produced, by the way. So
Exactly.
Niagara, right?
Go
So
Canada.
Go Canada. Oh, Canada. Yeah, exactly.
Would you ever drink this on the rocks, or are you a
I'm a
neat
neat
guy?
I'm a neat guy,
Yeah, okay.
but I would drink this on the rocks. I think
yeah.
I think it's smooth enough to drink on the rocks
Yeah.
that it would be very pleasant tasting.
That's my thing with the bourbon too. Like, there's lots of options out there. I find it like burns my throat. Not to sound, but this is really smooth and I enjoy it. So.
Yeah, this is really smooth. So to that, cheers, gentlemen.
Cheers.
Cheers.
Thanks for having me, guys. I appreciate it.
Thanks for coming.
Yeah.
Ian Wilson and Cameron Seasons.
Cheers.
That wraps up this episode of Bourbon with One Urban. That wraps up our episode with Ian Wilson and Cameron Stevens. Thank you for coming.
Thank you.
You bet. Thanks for having me.
Where dreams are built and bricks are laid. Till next plot twist. Happy building.
See you next time.
Thanks, guys. That's great. That's great.